What is the trigger rate? Whenever you make a mortgage payment, a portion goes towards paying down the principal, the amount of money you would borrow and are required to pay back. Another portion of your payment goes toward the interest, the percentage amount regularly charged to you by your lender as part of your mortgage agreement. When you have a variable rate mortgage, the amount you pay towards the principal versus that you pay towards the interest can change, depending on whether the prime rate, the baseline interest rate a financial institution uses for every loan, has increased or decreased. When the prime rate decreases, more of your payment goes toward the principal, whereas more of your payment will go toward interest if the prime rate increases. The term trigger rate describes the point when the interest rate on your variable mortgage rate has increased so much that your payments are not enough to cover the interest that occurs between payments and is no longer paying down any of the principal. What types of mortgages are impacted by trigger rates? Trigger rates impact variable rates mortgages. It's important to call out here that there are two types of variable mortgage rates in Canada. The first and most common are ones with static monthly payments, payments that may only change if trigger rate hit. The second, less common variable mortgage rates are those with floating payments. Payments change automatically with the change to prime rates. Most Canadians, however, have the former type of variable mortgages that only changes once a trigger rate is reached because, generally speaking, the static monthly payments protect the borrower's cash flow from nominal changes in the prime rate. But because over the course of the year the changes to prime rates from the Bank of Canada have been significant, it's important for Canadians with the static payment variable mortgage rates to know there could be seen increases made by their borrowers to their scheduled payments. How is the trigger rate calculated? For a more accurate understanding of your trigger rate, it's best to speak with your financial advisor. They will take the time to listen to you and understand your unique needs and goals. However, by following these steps, you can get an understanding of what to expect. Determine the amount you are expected to be charged for each mortgage payment. Confirm the number of payments you're required to make in a year, for example, whether your payments are weekly, bi-weekly, monthly, etc. Check to see how much of the mortgage balance you still have to pay off. Once you have all these details, you can calculate the approximate trigger rate with the following formula. Take your payment amount and multiply it by the number of payments per year. Then, divide that amount by the balance owing on your mortgage. Then, multiply that amount by 100. The result should give you a rough estimate of your trigger rate. Keep in mind that this is not your final trigger rate, and the result may vary. What are my options once the trigger rate is reached? Speaking with your financial advisor can help you outline solid plans in case you reach your trigger rate. The best practical options to consider before a rate increase include: convert your mortgage to fixed term. Not all mortgages have variable rates. Others are called fixed mortgages because the amount you pay in interest is the same regardless of whether the prime rate increases or decreases. Though you miss the opportunity to pay a lower amount when the prime rate decreases, you benefit from predictability and the confidence that comes with no longer worrying about triggering any special rates. Increase monthly payments. By increasing the amount you pay towards your mortgage, you add cushion room to your trigger rate. Though you're still exposed to the ups and downs of the prime rate, you benefit from putting down more towards your principal each month. Your mortgage is one of the most important parts of your long-term financial plan. You should reflect on your goals before making any changes to your mortgage. What happens if I don't take any action once the trigger rate is reached? Financial institutions can amend your payment if it is no longer covering the interest and will notify you of this change. As prime fluctuates with increases and decreases with the Bank of Canada as a variable mortgage member, a recommended approach to avoid the trigger rate is to connect with your credit advisor when there are predictions of increases.